Building wealth often feels less like a stroll down a paved road and more like navigating a hostile, uncharted jungle. There are predators hiding in the underbrush, actively trying to drain your resources. This graph shows two compounding growth curves over time. The top line is your money growing untouched. The bottom line shows what happens when a small, seemingly harmless percentage fee is skimmed off the top year after year. Those microscopic, invisible fees compound, eating away millions of dollars from your final wealth. Add relentless taxes on top of that, and your trajectory drops even further. You might assume the professional managing your money is there to protect you, but many regular brokers are not fiduciaries. A fiduciary is someone legally bound to act in your best financial interest. If your broker isn't one, the house often wins at your expense. To survive and reach your goals, stop acting as a passive consumer. Learn the rules of the system. Become an educated owner. This diagram breaks down the mountain of wealth accumulation into 5 distinct tiers. It gives us a map to track exactly where we stand. At the base is level 1, financial security. Your portfolio generates enough to cover basic survival costs like food and housing. One step up is level 2, financial vitality, which covers those necessities plus a few small indulgences like a vacation or a dinner out. Then we hit the tipping point. Level 3, financial independence. Your passive income fully replaces your need to work. You can find your target for this tier with a simple calculation. Take your current monthly expenses, multiply them by 12, and then multiply that total by 20. Higher still is level 4, financial freedom, where your investments can fund your ultimate dream lifestyle. And finally, the peak, level 5, absolute freedom. Here, you have limitless choice and the resources to contribute to the world on a massive scale. Moving toward these milestones requires precision. Once you determine your specific mathematical target, you have a concrete metric that allows you to evaluate every financial decision against a clear objective. The ultra-wealthy use specific strategies to build that critical mass quickly. First, they neutralize lifestyle creep by paying themselves first. Every time you get a raise, automatically divert a percentage of that new money directly into investments before it ever hits your checking account. Next, they shift their mindset away from the clock. You do not get paid for your time. You get paid for the value you contribute. Scaling your skills to do more for others than anyone else is the only truly limitless way to increase your income. As that income grows, you have to drop the extra weight dragging you down. You can dodge high broker fees by investing in passively managed funds, which simply track the broader market automatically with minimal overhead. And you can legally shield your money from the government by using tax-advantaged accounts like a Roth IRA, where your investments grow tax-free. Working harder to earn a bigger salary is only half the equation. The real speed comes from systematically engineering your financial life to protect and retain the maximum possible percentage of what you already make. Building wealth means nothing if you lose it in a crash. That brings us to Ray Dalio, one of the most successful hedge fund managers in history. He relies on asset allocation, owning a diverse variety of unrelated asset classes, as the engine of wealth preservation. This matrix categorizes the 4 distinct economic climates we cycle through, driven by rising or falling growth and rising or falling inflation. Since no one can predict the next climate, a portfolio must be balanced to survive them all. Dalio's all-seasons portfolio distributes risk precisely: 40% long-term U.S. bonds, 30% stocks, 15% intermediate U.S. bonds, 7.5% gold, and 7.5% commodities. This allocation strategy was back-tested through decades of market history, including the 2008 crash. While many aggressive portfolios plummeted by double digits, this specific mix lost less than 4% that year, providing the stability needed to stay the course through a crisis. Consider the story of all-in Anthony. He saved aggressively, pouring his money into stocks, but he retired right as the market collapsed in the year 2000. He started pulling money out while his portfolio was already cut in half, locking in those massive losses. Anthony misunderstood a crucial phase transition. Reaching the top of the mountain is the accumulation phase, but once you stop working and start withdrawing money, you enter the decumulation phase. Protecting a steady, reliable income suddenly becomes far more vital than aggressive growth. To ensure you don't run out of capital, you can use a risk management failsafe like an annuity. An annuity is a contract with an insurance company. You hand over a vulnerable lump sum of cash, and in return, they guarantee you a steady paycheck every month for the rest of your life. Scaling the mountain to financial independence means nothing if volatility throws you off a cliff on the way down. A structured, guaranteed income creates the safety net you need to actually enjoy the view. And that brings us back to the peak. Level 5, absolute freedom. What do you actually do when you reach the top? Scientific data shows that simply having a massive bank account doesn't increase well-being. Happiness only scales when money is spent in very specific ways. Researchers have found 3 proven methods to spend for happiness: buying back your own time to escape tasks you dread, investing in lifelong experiences like travel or learning a new skill, and investing in other people. Giving your wealth away actively creates a psychological state of abundance. It satisfies our highest human needs, the drive for significance and the need for continuous, meaningful growth. Wealth serves its highest purpose when treated as a tool to engineer a life defined by freedom, meaning, and giving back.